In 2007, Britain stood at the edge of an economic cliff, although almost nobody realised it. The UK's financial system appeared to be thriving. London was the global centre of finance, investment, and banking innovation. House prices were rising at their fastest rate in modern history. Personal debt had surpassed £1 trillion for the first time, and British banks were reporting record profits quarter after quarter. But beneath this confidence was a system held together by borrowed money, hidden risks, and a level of leverage the public had never seen before. What people thought was economic success was really a pressure cooker waiting to burst. And when it did, Britain would face its most serious financial crisis since 1929. To understand what truly happened inside UK banks during the 2007-08 crash, we must walk into the boardrooms, trading floors, and risk departments where decisions were made not over decades, but over minutes. By 2006, most major UK banks were following a similar business model: lend aggressively, borrow cheaply, and expand balance sheets to enormous sizes. Barclays, Lloyds, HBOS, RBS, and Northern Rock were competing for market share in mortgages, commercial loans, and complex financial products. The idea was simple: the more loans they issued, the more interest they would earn. But instead of funding these loans with customer deposits, many banks relied on borrowing money from global financial markets. This practice, called wholesale funding, allowed them to expand far faster than deposits could grow. At its peak, Northern Rock borrowed over 70% of its funding from global markets, not British savers. HBOS relied on wholesale markets for nearly half of its balance sheet. RBS, after years of acquisitions, had grown into one of the world's largest banks, holding assets worth more than the entire UK economy. All of this depended on one assumption: global credit markets would never freeze. That assumption turned out to be dangerously wrong. Inside UK banks, the real issue wasn't only mortgages, was the packaging of those mortgages into complex financial instruments. Investment divisions of banks bought and sold mortgage-backed securities and collateralized debt obligations, products tied to home loans across the United States. These were rated as safe, often AAA, despite containing risky subprime loans. Traders and executives were rewarded for short-term profits, not long-term stability, so they chased yields wherever they could find them. British banks bought billions of pounds worth of US mortgage-linked assets, convinced they were risked. Models at the time depended heavily on historical data that assumed house prices rarely fell together across the globe. But in 2007, when US homeowners began defaulting in large numbers, the value of these securities collapsed. The assets UK banks had purchased as safe began turning to dust. Losses grew quietly at first, unnoticed by the public, but inside risk departments, alarms were flashing everywhere. The first visible sign of the crisis in Britain came from Northern Rock. On the 14th of September 2007, BBC reporter Robert Peston revealed that the bank had requested emergency support from the Bank of England. It was the first run on a British bank in 150 years. People queued outside branches across the country, withdrawing over £1 billion in just a few days. But inside the banking system, Northern Rock's failure wasn't just a single institution collapsing. It was a warning that wholesale markets had frozen. Banks no longer trusted each other, so they refused to lend to one another. Interbank lending rates shot up. Liquidity dried out. Northern Rock had been the first to fall because it was the most exposed, but many banks were in similar danger. RBS, HBOS, and even Lloyds were facing liquidity shortages that could turn fatal if the markets remained frozen. Inside RBS, the situation was particularly severe. Only months earlier, in October 2007, RBS had completed its acquisition of ABN AMRO in one of the largest banking takeovers in history. The deal cost over £49 billion and was widely criticised even at the time for being rushed and overpriced. RBS financed much of the acquisition with borrowed money, leaving its balance sheet dangerously fragile. When the crisis hit, the bank was overexposed to toxic assets and short of cash. Executives attempted to reassure the public that the bank was healthy, but internally, reports showed capital ratios falling fast. On one day in October 2008, RBS was reportedly hours away from running out of money entirely. Gordon Brown and Alistair Darling had no choice but to step in. In what became the largest bank rescue in British history, the UK government nationalised RBS, injecting tens of billions of pounds to keep it alive. HBOS faced a similar disaster. Once the largest mortgage lender in the UK, its loan book was filled with commercial property loans that began defaulting as the recession spread. The bank's internal risk teams had warned for years that its commercial lending division was too aggressive, but executives pushed for rapid growth. When markets froze, HBOS found itself with a mountain of bad loans and no access to funding. Lloyds was pressured by the government to acquire HBOS in late 2008. The deal was intended to stabilize the system. But in reality, Lloyds inherited toxic assets that nearly destroyed it. Within months, Lloyds itself required a government bailout of over £20 billion. The image of British banking as stable and conservative collapsed overnight. Underneath the surface, banks had been operating with extraordinary risk, hidden leverage, and dangerously optimistic assumptions. On the trading floors of these banks, the atmosphere changed rapidly. Traders who had once earned bonuses in the millions now watched as their divisions lost billions. Teams that had been encouraged to grow portfolios aggressively were suddenly told to unwind them as fast as possible. In risk departments, staff struggled to calculate the true extent of losses because markets had become so illiquid that many assets no longer had a real price. Across the industry, employees described the same sense of disbelief. The financial system they had trusted completely was falling apart in slow motion. Some bankers later admitted that risk models used at the time were not designed for real-world stress, they were designed to meet regulatory requirements. In other words, banks followed the rules, but the rules themselves were flawed. Behind the scenes, the Bank of England and the UK Treasury worked frantically to prevent a full collapse of the financial system. They expanded deposit guarantees, offered emergency loans, and launched unprecedented liquidity facilities. The government eventually committed over £137 billion in capital injections and guarantees to stabilise banks. Although much of this was later recovered, the crisis left a permanent mark on Britain's public finances. The UK's national debt jumped sharply after 2008, rising from around 35% of GDP to over 80% in the years that followed. The recession that came after the crash was the deepest Britain had experienced since the 1930s. Businesses closed. Unemployment rose, and millions of families struggled under falling wages and rising living costs. Even today, many economists argue that the effects of the crisis shaped Britain's economic stagnation throughout the 2010s. Inside UK banks, the aftermath brought sweeping reforms. The Financial Services Authority was replaced by new regulatory bodies. Banks were forced to hold far more capital than before. The era of excessive leverage ended. Mortgage lending rules were tightened. Complex financial instruments faced heavier scrutiny. But these changes came too late to prevent the damage. For many British households, the crisis created a lost decade of slow growth, weak productivity, and stagnant living standards. For the banks, it ended an era where profit growth seemed limitless and risk appeared to be an afterthought. And for the public, it was a moment that shattered trust in institutions once considered pillars of stability. The 2007-08 crisis wasn't just a financial collapse, it was a structural failure of incentives, oversight, and risk culture inside British banking. It revealed that even the most respected financial institutions can be vulnerable. When built on borrowed confidence and unchecked ambition, what really happened inside UK banks was not a single mistake, but a system-wide belief that rapid growth could continue forever. When that illusion broke, the fallout reshaped the British economy for a generation. If you enjoyed this deep dive into Britain's financial history and want more episodes that reveal the hidden patterns behind economic events, make sure you like the video, share it, and subscribe to British Economic Archives. Your support helps us uncover more stories that shaped the nation's financial past and continue to influence its future. Thanks for watching, and I'll see you in the next episode.